As 2025 comes to an end, global financial systems are not reacting to a single event, but to a combination of signals that have been building quietly over time. In the last week of December, several major news outlets pointed to the same underlying shift. On December 29, 2025, Reuters reported that global markets were moving higher while precious metals reached record levels, driven largely by expectations that interest rates could be reduced in the future. Around the same time, Financial Times published detailed reporting on how inflation and currency weakness were eroding purchasing power in certain economies. In Europe, economists were discussing how changing trade flows could influence inflation without any increase in consumer demand. Taken individually, these stories might seem unrelated. Together, they describe a system adjusting its internal balance between money, trust, physical resources, and global trade. At the center of this adjustment is monetary policy. Markets are not reacting to an interest rate cut that has already happened, but to expectations about where policy is heading. In late December, Reuters noted that investors were increasingly pricing in future easing by major central banks, including the Federal Reserve. This matters because interest rates function as the price of money itself. They determine how expensive it is to borrow, how quickly credit expands, and where capital seeks protection. When rates are high, borrowing slows and money becomes cautious. When rates are expected to fall, borrowing becomes easier and capital starts looking for assets that are less dependent on yield. This helps explain why, according to Reuters, gold and other precious metals reached record levels at the same time. Equity markets showed only moderate movement. This is not a speculative response. It is a mechanical one built into how monetary systems function. As expectations around the cost of money shift, currencies begin to reflect confidence, or the lack of it. Currency stability is often discussed in abstract terms, but its effects are immediate. A stable currency allows trade to function smoothly, keeps import prices predictable, and supports long-term planning. A weakening or volatile currency does the opposite. It raises the cost of imports, feeds inflation, and makes everyday economic decisions harder. In reporting published on December 28 and 29, 2025, Financial Times described how inflation exceeding 40% in certain economies had effectively destroyed purchasing power as local currencies collapsed under sustained pressure. This is the extreme end of the same system that governs more stable economies. When confidence in monetary management breaks down, money stops functioning as a reliable store of value and becomes unstable as a unit of account. This currency instability connects directly to the renewed importance of physical resources. Throughout 2025, Reuters and Financial Times consistently reported strength in commodities, not only gold, but also industrial metals tied to infrastructure and energy systems. Commodities occupy a unique position in the global system. They are financial assets, but they are also physical constraints. Unlike money or credit, they cannot be created by policy decisions. They require extraction, energy, labor, and time. As confidence in purely financial assets fluctuates and currencies diverge, markets naturally place greater weight on assets that exist outside the credit system. This does not signal panic. It signals recalibration, money being repriced against physical reality. At the same time, global trade is quietly reshaping how prices move. In late December, European economists noted that increased imports from Asia, particularly China, could place downward pressure on inflation in certain markets. This discussion, reported across European financial media around December 29, 2025, highlighted an often misunderstood point. Inflation is not driven only by demand. It is also shaped by trade access, currency strength, and production costs. When cheaper goods enter a market, consumer prices can ease even if wages and consumption remain unchanged. This benefits consumers, but it also pressures domestic producers and alters long-term manufacturing decisions. Trade in this sense is not just logistics. It is a price-setting mechanism embedded within the monetary system. What becomes clear by the end of 2025 is that these elements are not moving independently. Expectations about interest rates influence currencies. Currency movements reshape trade flows. Trade affects commodity demand. Commodity prices feed back into inflation. This loop explains why markets often adjust before official economic data changes. The system moves internally first. What these late December signals do not show is a sudden crisis or an economic boom. They show recalibration. Money is being repriced against policy credibility, physical limits, and global production realities. This affects how expensive daily life becomes, how resilient supply chains remain, and how stable financial systems feel over time. These changes are gradual, but they are structural. Money ultimately is not just currency. It is a system of trust, constraints, and coordination. As 2025 closes, that system is clearly signaling a shift in the price of money, a renewed role for physical resources, and a quiet redistribution of global trade pressures. Understanding this does not tell us what will happen next. It explains why the system behaves the way it does right now. That is today's money signal.